So now the types of bonds that we just mentioned, the government bonds, let's take a look at them in more detail. We said there are federal bonds, which are all non-callable. In the federal, you have marketable bonds, which are, for example, there are government corporations, such as Farm Credit Canada as a corporation, which is run by the government, and they may issue the bond, which is marketable. Then there are T-bills, which are also issued by the government. They may be 3, 6, 9 months, and they're bought at a discount and they mature at par. Then there are Canada Saving Bonds, Canada Premium Bonds. They have been discontinued since November 2017, but you just need to know about them. And then there are real return bonds, which have principal adjusted for inflation. For example, if you have $1,000 and there's 1.5% inflation, then 1,015 is used for the interest calculation. Then you have provincial bonds, which are, there are guaranteed bonds which are issued by provincial corporations. There are Ontario savings bonds, for example, and every province has its own savings bonds also. And the Ontario savings bonds may be variable rate, or they may be fixed rate, or they could be step up, meaning they will be increasing as the years go along. Then there are municipal ones, which are also known as installment debentures or sealed bonds. So hopefully this makes it clear about the different types of bonds with the government of Canada. So once the bond starts to trade in the secondary market, traders are more concerned with the yield to maturity than its cost. It doesn't matter if you're buying a bond for a lower price or a higher price. What is important is that how much return will you get till maturity. So it takes into account not only the interest payment on the capital gain or capital loss, but also a bond that it'll generate over its duration. So bond pricing principles are that the bond prices are inversely associated with interest rates. So if interest rates go up, the price of bonds are going to go down. And if you have a long-term bond, it's going to be more volatile than a short-term bond. And low coupon bonds tend to be more volatile than high coupon bonds. So these special features attract special consideration. So bonds are traded at 100, and so it will trade in the secondary market at a discount or premium. So as we said, that there will be an inverse relationship between bond prices, interest rates, and usually discount rate, interest rate, yield to maturity usually are similar ways of telling what is the return that you can get. But the yield is not the same as the coupon rate. The coupon rate is a fixed amount that the bond will provide to the client who invests in it. And so we will take a look at how to calculate the yield in the next slides. And if the yield is equal to the coupon, it means the bond is trading at par. If the yield is lower than the coupon, it is trading at a premium. So again, volatility, we mentioned long-term bonds are more volatile. As bond approaches its maturity, it becomes less volatile. So let's take a look at this here, understanding these concepts also. We have a bond which is giving 3%, it's for 3 years to maturity, it's selling at 96, so you can get it at a lower price. Then there's another bond which is giving you 5%, it's going to be 2 years to maturity, and you can get it, but you have to pay more for it, 5% more. So, and then there's a third one which is 8% bond, which is 8 years to maturity, and you have to pay 107 for it. So these 3 bonds, how are you going to assess which is better? It's not just that the 8% one is good. It's not just that this is only a 2-year one. It's not that this is a discount. You have to do some calculations to understand, right? So if the client is going to put in $10,000 again, and based on whatever return they're going to get, they will get the money back. But it's difficult to determine which one should I invest in, which has better yield in 1 year, which has better yield to maturity if they hold it till maturity. What price should I pay, and is it a fair price? So these are the questions we need to ask when we're considering different bonds. And that is why we need to do the calculations for current yield and yield to maturity. So with current yield is a short-term measure of the return. It allows investors to compare investments in bonds with other short-term investments. It's the actual interest return that you can get in 1 year. So the current yield calculation is what is the amount of interest I can get in 1 year divided by the price that I have to pay to buy that bond. So this times 100, this ratio will be the current yield. Let's take a look at some examples also. This bond is issued at a 10% coupon, $1,000 par, and it's going to mature in 10 years. Let's suppose you buy it for 1,000, or you buy it for 900, or you buy it for 1,100. What is the current yield in these three situations? If you buy it for 900, we say you're buying it at 90 or 90% of the original price. At 110, you're paying 110% or $1,100. So first one, so if you remember from the formula says that you have to take the annual interest divided by the market price. Annual interest, we need to calculate what is 10% of $1,000. It is going to be $100, right? 10% of 1,000 is $100. So $100 divided by 1,000 that you're investing, 100 divided by 1,000 times 100 is going to give you 10%. So it means that 10% current yield is equal to the coupon rate. Now, if you buy cheaper for 90, simply 100 divided by, we're not going to do divided by 1,000, we're going to do divided by 900. Times 100 will give you 11.11%. So this is how it means now your current yield is a little higher than the coupon of 10%. It's good because you bought the bond at a cheaper price. If you buy the bond for 110, it means you're paying a little more. So now 100 divided by 1100, that's the price you're paying for it. And so times 100 will give you 9.09%. So your current yield is going to be lower than the coupon in this situation. That's because you bought the bond expensive, higher than the original price. So we did not hold that bond to maturity, but if you're holding a bond to maturity, then we need to do the calculation of the AYTM, or average yield to maturity, or simply the yield to maturity. So here we're going to take the annual cash flow, which is again the same, how much interest you're getting in a year, plus the capital gain or minus the loss. So we need to see, are we in a benefit on maturity or we're going to have a loss? And then you divide it by the average cost and you multiply by 100. So this is how we need to calculate. Let's take a look at this example. Same one, 10% coupon, $1,000 par value, 10 years to maturity. What is the AYTM if you buy it for 90 or you buy it for 110? If you buy it at the par value, so you will take the interest, that is again $100 in this case, plus you bought it for 1,000 and you're going to get 1,000 on maturity. There's no extra benefit, right? So 100 divided by 1,000, and the average price is going to be 1,000 because you're going to get 1,000 on maturity. You're investing also 1,000 divided by 2, that's 1,000. So 100 divided by 1,000, again times 100 will give you 10%. And as you can see in this case, if the bond price is equal to par, you're buying the bond at the same price, then the current yield is equal to coupon is equal to the AYTM. In this case, it is equal to 10%. AYTM when the bond is purchased for a discount. If you buy it at $900, now you bought it cheaper, so it means you have got a discount. It's good, you're happy. So you bought it for 900, you're going to get 1,000 at maturity after 10 years. So you're going to get $100 extra on maturity. But that's after 10 years. So $100 divided by 10 years means $10 a year you have a benefit. So $10 plus 100 is going to give you 110. 110 divided by 950. Where do we get the 950 from? $1,000 the maturity price, 900 is the investment. You're paying 900, so $1,900 divided by 2 will give you 950. When you calculate this 110 divided by 950 times 100, you'll get 11.57%, and that is the AYTM. And if you bought the bond at a higher price at 110, in this case, you're paying extra. So on maturity, you're still going to get $1,000 minus 1,100 you paid extra for it. So now you have a loss of $10. 100 divided by 10 is going to be $10. So 100 minus 10 is going to give you $90 at the top. And at the bottom, we have 1,050. Where do we get 1,050? 1,000 plus 1,100. The purchase price divided by 2 will give you 1,050. And when you calculate that, your AYTM is going to be 8.57%. It's a lower return because you bought the bond at a higher price. So the general rule that we saw, that we just mentioned, the coupon, if you buy it at the par at the same price, then your coupon rate is equal to AYTM, which is equal to current yield. And if the bonds sell at a discount at a lower price, it's good, then the current yield will be greater than the coupon. Like we saw there in this case, that you bought it at a discount at 900 and your AYTM is 11.57, which is higher than 10%. And if you buy it at a higher price at 110, your AYTM is going to be lower. So that is what we're saying here. If the bond trades at a premium, the AYTM and the current yield will be less than the coupon rate. You can also keep this in mind. So if interest rates if the prime rate or the market interest rates go up, the bond prices go down and yield go up. The prime rate, if it goes down, the bond price goes up and the yield goes down. So hopefully this makes it more clear. Our next section is about equities, so we'll talk about that in the next section.